Hey guys, welcome to another video. Thanks for joining me. In this video, I'll be talking about preferred stocks and how they differ from common stocks. In fact, by the end of this video, I will also be showing you a company that actually offers a preferred stock and a common stock and how these two stocks has performed over time. If you're familiar with investing in stocks in general, buying shares of good companies that we can hold for a long time, you know that the goal is often to buy great companies, hold them, and hopefully get paid in different ways. The first one is through price appreciation. Now, price appreciation is just the ability of a company to keep increasing in value. So for example, when Apple first issued their stocks, they were selling at about $22 a share. Now, if you bought Apple and held on to it up until this day, Apple currently sells for about $320, which means that if you bought one share of Apple at $22, that share will be going for about $320 now, assuming you held on to it till this day. And that is a typical example of price appreciation. The second way that we can often get paid is through dividends. Now, dividends are payments that are made quarterly by companies. Now, these payments could often be made maybe twice a year or could often be paid maybe once a year. It all depends. You just need to find the details in the company's reports. But the point is that this dividend payment is also a way for you to earn some money by investing in stocks. A word of caution, you have to understand that not all companies will perform well in the long term and not all companies will pay dividends to you, because dividends are generally payments that are paid when profits are made. If profits are not made, well, they do not pay dividends. And sometimes they even make profits and still choose not to pay dividends. This all goes back to decisions of the board of directors. If they choose to pay dividends to their investors, then you get paid as well. Now, in a situation where a company doesn't perform well in the long term, well, you stand a chance of losing your money. Because let's assume that you bought Apple for $22 a share and Apple went, say, bankrupt the following year. Well, what happened is that your share could be worth pennies, and there's so many companies like that because they've just performed so poorly over time. And in fact, some companies have performed over time and they have just been beaten out of the business. For example, Hertz is a common one that recently declared bankruptcy, and right now the shares of Hertz sells for less than maybe $3 or so. So you need to keep in mind that not all companies will perform well, like Apple, Amazon, Google, Microsoft, and all these big companies that we are familiar with. So the next question you're probably asking yourself is, why would I want to buy preferred stocks? So we already talked about what stocks are. Now let's focus on preferred stocks. Now, why are they called preferred stocks and how do they perform differently from common stocks? Because those are the two types of stocks that we have. Now, there are different classes of stocks, and that's a subject for a different video, but just know that there are two types of stocks that we can own. You can often own the preferred stocks and you can own common stocks. The one that you're generally familiar with are called common stocks, although you just generally call them shares or stocks. But let's talk about the preferred stocks and how they perform differently. A preferred stock is just an hybrid between bonds and stocks. When I mean stocks, I'm talking about common stocks. Now, the thing about bonds is that bonds are basically loans that you make to corporations, companies, the government, and so on. Now, when these bonds are issued by the company, well, they're trying to raise money and they look for investors that will borrow them some money. So they issue their bonds. When they buy the bonds, you own a right to that money. Pretty much, it's your money that you're loaning to them. So what will happen is that they're going to promise to pay you a certain interest on that money over time. Now, this interest will often come in as what they call coupons, and over the duration of that bond, at the end or at the maturity of your bond, you will be refunded your money, and obviously you'd have kept all these dividends over time or the coupons that they paid you over time. And that's how you can make money through bonds. When it comes to stocks, like I already mentioned, price appreciation or dividends. Now, when it comes to preferred stocks, this is just the hybrid of the two, because preferred stocks will often generally pay consistent dividends. When I say generally, it's not guaranteed, but they will generally pay dividends more consistently than common stocks. However, dividends are guaranteed for bondholders. They aren't guaranteed for preferred stocks, and they are less guaranteed for common stock holders. So the question is, why would I choose to invest in the preferred stocks? Well, like I said, one, the dividends are payments are more consistent. The second thing about preferred stocks is that you are at a position in which, in case the company goes bankrupt, you'll be considered ahead of common stock holders. So the hierarchy is this. In the case of a bankrupt company, when they sell all their assets, the first people they pay are the bondholders, and these people will generally get their monies first. If something is left after the liquidation of the company, the preferred stockholders are the next. And if something is left, whatever is left is then spread amongst the common stockholders. So you can see that in a situation of just minimizing your risk, you are probably better off owning preferred stocks over common stocks. The other benefit of preferred stocks is that in comparison to common stocks, you would notice that they don't fluctuate as much. That means they are not as volatile as much as common stocks. Common stocks often, can drop as much and gain as much as well. Whereas with preferred stocks, they are generally more stable. Obviously, bonds are generally the safest types of investment, but at the same time, returns are very low. If you are going to choose preferred stocks because of the dividend payments, like I said, these are not guaranteed, and that means you are not promised that money. This is something that is more consistent compared to the common stocks. So one of the key benefits of common stocks over preferred stocks is that you have voting rights over preferred stockholders if you own common stocks. Okay, so for example, if you bought Apple shares, the AAPL that we know, you have voting rights. So the more stocks of Apple that you own, the more voting power you have. However, people that own preferred stocks generally don't have any voting power, which means that you might have a lot of preferred stocks, but you have no voting power for that reason. So let's look at a good example of a preferred stock and a common stock of the same company, and let's see how they have performed over the time and how the dividend payments are made, and just look at the differences. All right, guys, so just to let you see exactly the differences between a preferred stock and a common stock of a company. This is a company that I found out has a preferred stock and also offers the common stock as well, Assurance Inc. This is a financial company, it's an insurance company, and it's under the financial sector. So right now, this is the ticker symbol AIZ for the company, and this is the common stock. As we can see here, it shows the pricing, the days range, it shows you the PE ratio, earnings per share, outstanding shares. These are the shares that are currently held by investors. All right, that's the shares outstanding. The market capitalization is worth about $6.2 billion. And also we can see historical volatility, which I want us to pay attention to, 45.3%. And the other thing I want us to pay attention to is the annual dividend yield. Okay, that is the common stock. Now let's look at the preferred stock and let's see the differences. All right, so here's the preferred stock of the same company. You can see now it is designated preferred with a P, AIZP, and it also says it here. Now, obviously, depending on the company that you invest with, these designations would generally be the same because that's a ticker symbol, but it may not say preferred stock in yours probably, but just read to make sure you're investing in preferred stock. Now here you can see that the price on this one is 104.15. So if you look at, let me go back to the common stock. The price was 103.06. Today's open price of this one was 103.89, and the same open price of the preferred is 103.69. So you can see the performance is a bit different. The other thing also that I told you to pay attention to is the historical volatility. Remember, the previous one was 45.3. This one for the preferred stock is 35.2. So you can see it's less volatile, which means that the preferred stock could gain a lot of money, but also could lose a lot of money. Whereas this, in comparison to the common stock, won't perform as drastic or won't be as volatile as the common stock. Then the other thing I wanted us to pay attention to was the annual dividend yield. As you can see, this one is about what, 6.50 or 6.50 dollars, whereas you can see it's about 6.24% annual dividend yield. For the common stock, which is this one, as you can see, is what, 2.45% or $2.52. The other thing is the chart. So let's look at the chart. All right, here, this is a 3-year chart, and I know I can make this bigger, but as you can see how this has performed, you know, in July, it went down 3 years ago, October, and then made some gains here, eventually went back into the red over this average price here. All right, about $105 or so, or $4, somewhere in that range, based on the current closing price. As you can see, it barely went above it for a long time in this range. This is for the common stock. If we then go to the preferred stock, see the difference. All right, for the same average price, you can see how the preferred stock has performed in comparison to that same price range, all right, of the average closing price. So this tells you that, you know, these stocks, even though it's offered by the same company, the performance will always be different. Then the last thing I wanted us to pay attention to is the dividends. As we can see, they paid a dividend of about $1.63 as at May 29, 2020. They paid one in February, $1.63. And you can see that these dividend payments are consistent in even the amount per share. On the other hand, for the common stocks, let's look at the dividend payments. So they paid one on May 22, the same month, for 63 cents per share. All right, that is what they paid in May. They paid 63 cents again in February. They paid 63 cents here last year, and you can see they paid 60 cents here. So the key thing here is that the preferred stock obviously is paying more consistent dividends, and it's performed overall, it's performed a bit better. Now obviously they've almost arrived at the same price right now, but the point is you can see the less volatility involved even through the chart, through the dividend yield, through the volatility, and even the pricing. Hey guys, and that's it for me. All right, if you guys have found value in this video, please consider giving this video a thumbs up, and also let me know your thoughts in the comment section below. If there's something that isn't clear, please ask your questions below. I'll try to answer them. Obviously I do not know everything, but I'll try to answer them to my best of my abilities. Please consider subscribing to the channel because it definitely encourages me and helps the community to keep growing. I do appreciate you watching the video to the end, and if you're interested in more videos, please check out the stocks videos that are here that are very, very interesting. I know you'll find value in them.